I'm Gavin Souter. I'm the editor of Business Insurance, and I'm here today with Ellen Charnley, who is president of Marsh Captive Solutions, and she's going to discuss trends in the captive sector. Hello, Ellen.
Hi, Gavin. Nice to see you.
Great, thanks for joining us today. So in hard markets or hardening markets, you often see people become more interested in captives, whether it be their existing captives or forming captives. Is that something that you're seeing? What are you seeing at Marsh?
Definitely seeing that. It's unprecedented, and I thought we were done with that word last year, but we are continuing to have unprecedented captive activity. That's for sure. A lot of activity, people discussing use of captives. If they haven't got a captive already, they want to quickly form a captive, at least understand what a captive is. We've had more captive formations than we've had in the past. We're also seeing companies that have captives expand the use of their captives. So typically a hardening market definitely encourages more captive use. So certainly we've had very, very busy time in the last year.
Would that be across domiciles, or are they concentrated in any particular domiciles?
No, across the globe, actually. I've seen it throughout the world, from Asia Pac all the way through to Europe, and in the US as well. So growth throughout, and I think that is indicative of the fact that we've seen the hardening market throughout the globe as well, not just in any one region.
Great. And you say that people are kind of looking at making more use of their existing captives. Maybe you can go into a little bit of detail on that. What sort of things are people doing differently with their captives now than they were, say, a couple of years ago?
Yeah, I think people are very happy if they've got a captive already. They're very happy that they've got one, and that they have been able to leverage that. So, for example, increased retentions and deductibles to sort of leverage the market position and sort of control the overall total cost of risk. Sometimes companies are taking a quota share in the overall program structure, even taking higher layers, additional limits, so that plugging gaps in their program structure, really bringing the captive into the overall program structure, and having the captive have a seat at the table, perhaps where they haven't necessarily needed it in the conversation in the prior sort of soft market conditions. Across all lines, not necessarily just more traditional lines as well, and also using it for lines where they would never necessarily have considered it. So not just in P&C, in the traditional lines, but also employee benefits, and also perhaps those sort of newer emerging risks where perhaps 10 years ago we would never have dreamed a captive would play. Because perhaps they were sort of less traditional, a higher severity, low frequency risk. Now captives, particularly mature captives with perhaps an abundance of surplus, have played a very important role in this hardening market.
Great. What are some of those risks that are coming into captives?
Yeah, I would say we're seeing a popular favorite right now would be D&O risk, which would be something that we would never have dreamed about seeing in the sort of 5 to 10 years ago. Companies are seeing big increases in the market rates for D&O risk. And in certain instances, they can't even buy sufficient D&O risk, so they're left with very little choice of what to do to get coverage. And a captive in certain situations can be a good alternative. Doesn't always work, but it can be an alternative for certain organizations. And so we've been helping a number of organizations think through how a captive can help with certain D&O risks. So that's been one example which I think has been very interesting to help clients with. Particularly, I would say other areas would be sort of on business interruption, more traditional risks like auto liability. We've seen a number of risk retention groups forming in the US to try and sort of combat significant increase in auto liability premiums, really across all risks and all industries. It's been really fascinating to see, and for a captive industry, long may it last.
What are some of the advantages that the captives get by placing some of these risks or the captive owners get rather, by placing some of these risks into their captives? Is it just to plug holes in the program, or are there other advantages that they can gain?
Well, I think it's all about flexibility. Ultimately, a captive allows a captive owner and an organization to have flexibility in arranging and taking control of their overall total cost of risk. And so when markets are hard, they can leverage their captive to be flexible with their program structure and to manage that volatility. And to hopefully take out those peaks and troughs. They don't have to, explain to their CFO and the treasurer about having to huge insurance spend hikes when they can manage that volatility through the captive. So I think flexibility is the key that it affords for them. Accessing reinsurance would be another area that allows that flexibility. Another area of flexibility that a captive affords them. Without a captive, there's a whole host of markets that are really unavailable. That in a hardening market potentially can become a lot more attractive. So I think that flexibility word is key.
Great. And from what you've seen so far, I mean, how is 2021 shaping up? Do you think it's going to be another big year for captives?
I do. It's already kicked off with a bang. We've formed already a number of new captives and new cells. Actually, I would say the cell formation is another area that we've seen a boom in, companies forming cells across various different jurisdictions, seeing that as a quite a quick and efficient way to form some form of captive entity. So I see that as being another area that's going to continue to grow, and companies are forming captives and increasing their use of their existing captives. Watch this space. We'll be seeing more of it for sure, and we already sort of saw a lot of it last year. We're going to continue to see more of it this year. That's for sure.
Is anybody looking at pandemic-related risks?
Yeah, and we've had it. We have. I think it's a handful of companies that already write some form of pandemic-related risk in their captive, but not. It's literally a handful. I think it's something like 20, 25 or so. I think we launched that. We published that number in our landscape report last year. We did actually think there would be more companies that would be more interested in doing it this year, but I think the interest has waned a little bit. I suspect if there's some form of public-private partnership that gets formed or enacted, there'll be more interest, particularly if captives are part of that solution in 2021. Something like the PREA Act, if that actually gets formed, then I think captives will play a part in that. So I think watch and wait and see a little bit on that. We've had a number of inquiries, and we've been working with a number of reinsurers on trying to structure it. At the end of the day, it's still quite expensive, and I think some companies are still trying to think about whether or not they want to sort of invest in that sort of area. I think it's still maybe a little bit too early to see whether companies are going to go down that area. I think trying to deal with other risks first, I still think is the way that companies are going.
More something for the future than today.
Yeah, maybe. Yeah. We'll see.
Great, excellent. Well, thanks very much for joining us today.
Yeah, thank you very much for having me.